What's up, everybody? Welcome back to the DO Show. Today's episode is for loan officers or mortgage brokers, VPs of lending, whatever you want to call yourself these days. Anyone who is trying to figure out what matters right now and what's going to matter 5 years from now. Because the mortgage business has changed, technology has changed, borrowers are changing, referral partners, they too are changing. And the LOs who are winning today are not just working harder, they're working differently. Today we're talking about the modern loan originator. What does that actually mean? What skills matter now? What tools should you be using? What should you stop doing? And what should you double down on? We're going to break this episode down using a simple format. First, I'm going to answer 3 real questions from the audience. These are questions loan officers like you are asking every single day. Then we're going to talk through 2 recent news stories that directly impact how loan officers should be thinking about their business. And finally, I'm going to give you 1 core insight that ties this entire episode together. It's the difference between what I call the job and the work. If you understand this distinction, it changes how you operate immediately. This episode is not about trends. It's about fundamentals. So, let's get started. This is the DO Show. They don't teach this shit in school, but they should. I'm Dustin Owen, and for the past 20 years, the mortgage industry has been my classroom. I've helped over 2,000 families become homeowners, built $1 billion mortgage operation from scratch, and earned my way into the top 1% of income earners worldwide. Along the way, I became a real estate investor, a business owner, and have invested in over 20 tech startups, even hitting a 20x return on one of my investments. This isn't theory, it's experience. Welcome to the DO Show, where I teach the lessons life taught me the hard way. Segment 1, 3 questions from the audience. Question number 1 comes from Sarah in Kansas City. Sarah asked, how can I leverage AI in my day-to-day as a loan originator? And this is probably one of the most common questions we are getting right now. Look, AI is everywhere. It's also nowhere, but it is everywhere. Everyone's talking about it. And most loan officers are either overestimating what it can do or underestimating how useful it actually is. Here's the way to think about AI. AI does not replace loan officers. AI replaces repetition. Your goal is not to let AI think for you. Your goal is to let AI save you time. The biggest place AI helps loan officers right now is in communication. So let's talk about email. Most loan officers spend a shocking amount of time writing emails. Writing them again, rewriting them, proofreading them, formatting them, starting over because they don't like how it sounds. You feed AI examples of emails you already like, your tone, your style, your voice, and then when you need to follow up with a borrower or an agent, you give it context. Borrower hasn't responded in 2 days. Appraisal timeline question. Write a follow-up that sounds like me. So then AI drafts it, you edit it, you personalize it, but you didn't start from zero. That alone saves you minutes per email. Minutes add up to hours, hours add up to real capacity. AI also helps with templates. If you explain the same things over and over again, whether it's loan options or next steps in the process, reviewing disclosures, going over credit, down payment strategies, you shouldn't be rewriting that from scratch. AI helps you build a library of explanations you can customize quickly. Where AI does not belong is in replacing judgment, empathy, or relationships. AI can write, but it can't reassure. It can't read emotion, and it cannot build trust. Use AI to clear your plate of busy work so you can show up fully where humans still matter. Now, when we fast forward 12, 24, even 36 months from now, I do believe that AI is going to help us fulfill a lot of the work that needs to get done. But you know what it won't take? It won't take place of the job. And later in this episode, I'm going to differentiate for you the difference between the job and the work. Question number 2 comes in from Jody in the Pacific Northwest. Jody wants to know, do I need a social media presence to fund more loans? Quick answer, no, not necessarily. Short answer, of course you do. No, you don't need social media to fund loans. People funded loans long before Instagram and TikTok existed. But yes, you need social media if you want to scale, if you want to leverage, if you want people thinking about you when you're not in the room. Social media is visibility, and visibility creates familiarity. And familiarity creates trust. But here's where loan officers get it wrong. They think posting equals value. It doesn't. Posting useful content equals value. If your content helps people understand the mortgage process, understand what to expect, understand how to prepare, understand the market, then social media becomes an asset. If your content is random, inconsistent, or just noise, then it becomes a distraction. You do not need to be everywhere. You need to be somewhere consistently. Social media should do one of 2 things: educate consumers or reinforce confidence with referral partners. If it does neither, it's not helping you fund loans. So no, social media is not mandatory. But yes, it is one of the most powerful leverage tools available to modern loan officers when used correctly. So think about this. There are plenty of people in today's day and age that are funding hundreds of loans per year, and socially they don't show up. But more than likely, they were funding hundreds of loans per year before social media even existed. If you want to be a modern mortgage loan originator, showing up online is imperative. It's the most economical way to remind people of who you are and what you do for a living. It's the easiest way to warm up an audience before you reach out to introduce yourself in person in order to get a meeting so that you can build a relationship. And always keep this in mind. When you're posting, people do business with people. And typically people do business with people they know, like, and trust. But if they don't know you, there's no way they'll like you. And if they don't like you, there's no chance you'll ever get them to trust you. Posting online is a way for people to get to know you. So not just know about what you do professionally, but also who you are as a person. I'll tell you this, if I was coaching you, I'd be coaching you one-on-one every single month. Yes, I want you showing up online and showing up on Facebook, Instagram, LinkedIn, and even TikTok is a phenomenal way to show up for the people who are already in your circle, as well as the people that you're going to be inviting into your circle in the future. Question 3 comes from Mark up in the ATL, Atlanta, Georgia. What's going on, Mark? What can I do outside of realtor relationships to increase my volume? This is a great question. Too many loan officers believe realtors are the only path to growth. And trust me when I tell you, they are a phenomenal path to growth, but they're not the only path to growth. Realtors are incredible partners, but they're not our only partners. There are 3 areas loan officers consistently underutilize. The first is your circle of influence. These are your friends, your family, your neighbors, even your ex-coworkers, right? These are people who already trust you. They already know you. But here's the deal. Most of us, most mortgage brokers and loan officers, we don't treat our circle of influence as if they are already clients. But a modern mortgage loan originator who wants to not rely heavily on realtors will recognize if they just started treating their circle of influence as if they were already clients, they would start generating more referrals and more leads from those people. Now, what do I mean by treat them like clients? Well, if you're already doing annual mortgage reviews for your past closed clients, do them for your circle of influence. If you're already sending quarterly video market updates to your referral partners as well as to your closed clients, include your circle of influence. This intentionality can help you generate more leads from a segment that is often overlooked. And the second of 3 non-realtors you can build relationships with to generate more referrals or more leads, financial advisors or wealth planners. Like, these professionals serve clients who often need mortgage guidance, but many of them don't have a trusted loan officer they rely on. If you build real relationships with these professionals, not transactional ones, what will end up happening is that they will see you as the advisor you are. You will create consistent referral streams. Know this about working with financial advisors. You typically only need 3 that are in your go-to Rolodex of people that you rely on. The first thing is understanding that financial advisors, they also are looking for clients. So when you meet with these financial advisors, ask them who is their ideal client and how do they like to be referred. The second thing you want to understand about financial advisors is some financial advisors work for institutions that are already tied to mortgage. For example, JP Morgan is tied to Chase. Chase Bank has a massive, robust mortgage department. A relationship with a JP Morgan wealth advisor probably isn't advisable. Same thing goes for Merrill Lynch. Nothing wrong with Merrill Lynch. I used to have my money with them for years. But Merrill Lynch is owned by Bank of America, and more than likely, if you're a Merrill Lynch advisor, you are incentivized to refer Bank of America's mortgage team. Now, the financial advisors I do like to partner with, people from Northwestern Mutual, people from Edward Jones, or even people from Mass Mutual. Those types of professionals tend to make great partners, as well as the men and women who work for the small, local financial advisor firms in your market. Now, the third type of non-realtor is when you go directly to the consumer. Now, this is a long play, and it's way harder than it seems. You have to keep in mind, the minute you start going after the consumer, you're now competing against every major bank. You're competing against Rocket. You're competing against Bankrate. You're competing against LendingTree. You're competing against people who have all of the technology, all of the experience, and all of the resources at their disposal to get their message in front of the consumer first. Within this segment of what I would call going directly to the consumer, this is how I would do it as a loan originator. I'd look for employer partnerships. I would look to do in-person lunch and learns, virtual home buying workshops. An employer partnership works like this. I reach out to a major employer in my local market. A major employer is anybody who employs 50 or more employees, and I make contact with their HR manager. That HR manager is looking for employee benefits. Employee benefits could be lunch and learns that I do in person, or an employee benefit could very well be a discount that I offer to anyone that is employed by that company. The second way I would look to do it is virtual home buying workshops. Now, keep in mind, this is very much a webinar, and the hardest part about the webinar is getting people there. So it's going to take some knowledge, some energy, some experience, and a little bit of a financial investment, because what you're going to want to do is have a landing page. You're going to want to then run ads online to push people to your landing page in order to get them to attend your virtual home buying workshop. Once they've attended your virtual home buying workshop, you need to have some reason for them to take the next step with you. And you also need to have a robust CRM that you use, A, in order to get people to show up to the virtual home buying workshop that they originally registered for, and then B, how do you convert them into a pre-qualification or even a pre-approval? That's sometimes the most difficult aspect, but if you are looking to generate business outside of realtors by going directly to the consumer, these are 2 proven ways. I mentioned there could be a third way. The third way would be doing these workshops in person. Whether you do them for your congregation because maybe you're affiliated with a certain church, or you do them at a community center, the same thing applies with doing them on virtual. It's the key is getting the people butts in seats. Once you can factor that, now all of a sudden you can start generating leads directly from the consumer. And keep this in mind. When you teach instead of sell, people lean in. You don't need permission from a realtor to educate the public. Modern loan officers bring value to people, and that value turns into volume. Segment 2 is when I'm going to go over 2 news stories my team and I found that are very relevant to loan officers right now. So we're going to slow it down, and we're going to talk about what's going on in the world. Not hypothetically, but what's actually in the news that impacts loan officers today. We're going to walk you through two very real recent articles, and I'm going to give you some commentary in a way that connects it to your daily work, your strategy, and the decisions you're making with your team or inside of your business. So the first article comes to us from our friends over at Housing Wire. It's titled, "Mortgage Rates See Modest Decline, but Buyers Remain Cautious." Let's unpack this. The headline sounds encouraging. Mortgage rates saw a modest decline. And on the surface, that sounds like good news. But as you read the article, a few deeper points jump out. First, the article points out that while mortgage rates have slightly eased, buyer confidence has not rebounded at the same pace. In other words, as rates moved down, the buyer psychology didn't move up. Now let's talk about why this matters. Most of you know that loan officers don't fund loans because rates move. You fund loans because people decide to move forward. The news here isn't the rate movement. The news is the disconnect between rates and consumer confidence. What Housing Wire was describing is a market where buyers are still cautious. They feel uncertain. They're afraid of overpaying. They're worried about job stability. They're watching inflation. So if you're a loan officer who only talks about rates, if that's your primary message, you're in big trouble, because that's not what buyers are truly reacting to. Buyers are reacting emotionally. They're reacting to fear of overpaying. They're reacting to complexity. They're reacting to frustration with conflicting headlines. So here's what you need to hear. Your job as a loan officer is not just to quote a rate. Your job is to interpret the rate for the person in front of you. That means explaining what a rate actually does to a monthly payment, how a rate matters relative to the buyer's timeline, what down payment strategies can do in various rate environments, how pricing changes relate to actual cost over time. And here's the thing that most loan officers miss. Buyers don't hate high rates. What they hate is uncertainty. They want stability. They want predictability. They want clarity. That means your value is not in telling them what the market is doing. Your value is in telling them what the market means for them personally. That's the real takeaway from articles like this. It's not a rate story. It's a psychology story. And that's where loan officers with real impact win. The second news article, this is coming from Forbes. The title, "AI Adoption in Financial Services Hits Record Levels." Holy cow, record levels? Are you kidding me? Get out of town. All right, let's talk about this one. This article shows up on Forbes and it says what a lot of us have seen anecdotally. But now there's data to back it up. Adoption of AI technologies across financial services is accelerating much faster than experts predicted. This article highlights a few key areas where this is happening. Automated communication tools, document processing, underwriting workflows, customer service, data insights. Now, when loan officers read headlines like this, a few reactions typically show up. Some people say, AI is going to replace loan officers. Others say, AI won't matter to me at all. But on both those reactions, I think we're missing the point. Here's what the article actually points to. AI is not going to replace loan officers, but it will replace the tasks that loan officers used to do manually. So let me break this down for you. There are two categories of work in mortgage lending: repetitive, predictable tasks, human judgment-based decisions. AI is extremely good. In fact, it's ideal for the first category. That includes writing first draft emails, summarizing conversations, extracting data from documents, tagging files, setting reminders, organizing priorities. Now, AI is not good, and it cannot be good at the second category. Think about this: empathy, relationship building, negotiation, explaining nuance, adapting communication styles to meet the individual on the other end of the call, reading context beyond the data. This article really underscores that reality. And here's the part loan officers miss. AI is not a threat. AI is a dividing line. The divide is between LOs who see AI as a tool to evaluate their effectiveness versus LOs who see AI as someone who will replace them. One of those mindsets wins, one does not. AI will automate the busy work, not the heart work. And that's exactly why your job, the human stuff, becomes even more valuable. That's the hidden insight in this Forbes article. AI will replace tasks, human intelligence will replace relationships. And in mortgage lending, relationships still drive volume. So that takeaway here isn't fear. The takeaway is clarity. You should be asking, what parts of my day should be automated? What parts of my day must be human? How do I double down on the things AI can't do? How do I free up more of my time to focus on strategy and connection? Those are the questions that create real advantage. That leads us to segment 3. Segment 3 is not about your questions or the 2 articles that I found, but it's one idea, one concept I need you to really think about. This is the part that changes careers. This is the part people talk about, but rarely actually understand. And it's this. There's a massive distinction between the job and the work of a mortgage loan originator or a mortgage broker. When you confuse these two, you end up busy, exhausted, overwhelmed, and underperforming. When you understand them clearly, everything becomes easier. Everything becomes more strategic. Everything becomes more intentional. So let's break this down thoroughly. Let's first talk about the work. When I talk about the work as an MLO or a VP of lending, it's answering emails, it's uploading documents, it's running scenarios, it's updating the CRM, checking compliance, it's scheduling appointments, formatting disclosures, right? That's the work that we get to do when we do a great job. If you did a time study of a loan officer's day, most of these tasks would show up. And here's the problem. Most LOs define their day by the work. They say, I spent all day working. Look how busy I was. But busy does not equal productive. And busy does not equal impactful. Busy is just noise. Work is activity, that's it. Now let's look at the job. Y'all, the job is to get a lead, right? The job is not tasked. The job is the human outcome. The job is generating a lead. The job is going on an appointment. The job is having meaningful conversations. The job is to turn a pre-qualification into a pre-approval based on the words that you used. The job is showing up and giving a realtor presentation. The job is making sure that your marketing strategy is well drafted and then also well executed, right? That's the job of a loan officer. And successful loan officers, they understand that it's not about being great at the work, but it's being great at the job. These people are educators, they're trusted advisors, but they're also professionals when it comes to marketing, when it comes to networking, when it comes to referral relationship management. That's the job. The work can be automated. The job, not so much. But if you spend all your time on the work because it's easier, because it's tangible, because it feels urgent, then you don't have time for the job. And the job is what actually drives results. Let me give you a real example. You have 2 LOs that both got to the office at 8 a.m. and they both wanted to finish their day at 5 p.m. Loan officer number 1 says, man, today was a busy day. I answered all of my emails. I ran compliance on 3 loans that had to get disclosed. I updated my CRM. I attended 3 operations meetings. Plus, I did 1 new product review. Loan officer 2 says, today was an amazing day. I went and taught a lunch and learn at a local RE/MAX office. I had a new lead come in and I showed Sarah the power of yes by showing her how she could buy her first home utilizing a down payment assistance program. I scheduled 2 meetings, one with a realtor that I don't know, but she was a listing agent on a transaction from last month, and one with an agent I haven't worked with in over 6 months. When you look at those 2 days, which person was the most successful? Was it the person who got a lot of work done? or was it the person who mastered their job? When you look at these two, guess who built stronger relationships? Guess who funds more loans? Guess who will have more referrals next month? Y'all, it's not even close. Loan officer number 2 will outproduce, outkick, and will crush loan officer number 1. It's common for LOs to get stuck in the work because it's visible, it's tangible. You can check it off a list. You can point to it and say, I did this. But you know what? You can check off all the busy work in the world and still not make more money. You can be the busiest person in the office and not be the most productive. And that's because the job, not the work, is what produces outcome. How do you shift from work to job? All right. Well, now that you have an understanding of the difference, let's talk about how to make the shift. Number 1, audit your daily calendar. Look at how much time you spend on repetitive tasks versus human outcome work. Number 2, identify what you can automate or, better yet, delegate. AI can handle repetitive tasks. A loan officer assistant can handle scheduling, CRM updates, templates. And then number 3, free up your time for the human moments. That means client calls. That means going over scenarios. That means handling objections. That means partnering with realtors. That means hosting events. It's pretty simple. What differentiates high volume producers from low volume producers is a high volume producer focuses on doing the job extremely well, and they utilize AI or they utilize a team for the work. Or they recognize the work is what they can do nights, weekends, or early in the morning. So let's put a big fat bow on this and bring it home. If you want to scale your business, this is one of the biggest mindset shifts you can make. You don't scale by doing more of the same task. You scale by elevating the human impact of what you do. Remember, nothing changes if nothing changes. If you want better results, you're going to have to make certain changes. AI and automation are not threats, they are amplifiers, but only if you understand what your core value really is. And your core value is not the work, it's the job. Once you see that, everything else becomes easier. Subscribe right now to watch more episodes of The DO Show, right here on T-Lop Entertainment. If you like this type of content, make sure you share it because sharing is caring. Unfortunately for us, that is all the time I have for you today. I'm Dustin Owen, and I do look forward to seeing you on the next episode of The DO Show.